So I've done one slide on the recession in home prices. I've done one slide on inflation in home prices. And most recently, I've done one slide on inflation and interest rates using three different examples. So let's go a little bit deeper and bring it all together and talk about the Fed, inflation, recession, and how it affects interest rates. I'm going to share my screen. So the one I did on inflation and interest rates, I'm going to blow this up a little bit so you can see. This is what I did most recently, and where I was talking about. So inflation is obviously bad. We're all feeling it. Prices of everything are going up. Our dollar isn't stretching the way it is. And the Fed's job, one of the major jobs of the Fed, is to keep inflation down. They like to keep it under 2%. And I went through the history of inflation and how when we have inflationary periods, mortgage rates will rise, and then the Fed jumps in, raises the Fed funds rate, which is short-term interest rate, not 30-year fixed, but the short-term credit cards, lines of credit, and they'll raise that to slow the economy. And then the response is that inflation starts to go down again, and the mortgage rates actually respond by going down also. And I actually stopped at mortgage rates when I was talking about inflation and rates. But the consequences is that it usually leads to a recession because as quiet as it's kept, those who are running the Fed, they're mostly academians and aren't really in the trenches. So they'll usually overcorrect. And by the time they realize they've overcorrected, we're in a recession, which is essentially where we're headed. But as I've mentioned before, bad news economically can often be offset in the mortgage market. One of the things is, the people are uncertain about the stock market. So they move their money into bonds, and mortgage rates are based on bond rates. So I wanted to show you this chart. And it's just going deeper. I had three examples previously. Here are the last six recessions, and you see where the interest rates have gone. 1980, 81, 82, which lasted for, 16 months, early 90s, early 2000s. Then the big one in 2000, surrounding 2008, the crash of the housing market. But you see in all six examples, of most recent examples of the recession, interest rates have gone down. So more than likely, sometime here again in the next 6 to 18 months, we're going to see the interest rates improve. And there's going to be opportunities for people to refinance. So that's the one slide for the day. Again, don't listen to the talking heads and let's bury Habib on CNBC. Talk to someone who's in the trenches like myself, or if you have a mortgage advisor, ask them to discuss these types of things with you. Have a fantastic day.